What's up, YouTube? In this video, we're going to be talking about the 5 simplest ways that you can go about saving thousands of dollars in taxes as an investor. This is an extremely important topic that I discuss with all my clients and students, and I want to make sure it's one that you're familiar with because, as you may or may not know, the more that your income goes up and the more that your net worth and your investments grow over time, the bigger the impact that taxes can have on your wealth and your progress towards your goals. So we're going to spend some time today talking about some of the simplest ways you can go about reducing the amount that you're paying in taxes to keep more money in your pocket instead of it going to Uncle Sam. So let's go ahead and dive into the video. Method number 1 is simply using what's called a tax advantage accounts. And this is a fancy way of saying using investment accounts that have special tax benefits. A lot of these are going to be like your retirement accounts. Some examples I have here listed are like the Roth IRA. Other types of IRAs are included. Even employer retirement plans like 401ks fall into this category. HSAs are one of the most tax-friendly investment accounts for health expenses, 529s for education. So there's all sorts of different accounts you can use. They're considered tax advantaged. With the traditional accounts, right? These are accounts you can put your money into, and you can usually deduct the money that you put into these accounts on what's called a pre-tax basis. In other words, you can write off the money that you put into these accounts, and in a lot of cases, that can reduce your current tax bill. With your Roth accounts, the money is taxed up front, but if you meet the requirements down the road, all the money can grow without being taxed, and down the road, all the money can be withdrawn completely tax-free as well. So lots of tax savings there also. And in all cases, whether it's traditional or not, the key benefit to tax advantage accounts is the fact that the money inside these accounts can be invested and that money can grow without being taxed as long as the money stays inside the account. And again, with the Roth accounts, the growth can also be withdrawn completely tax-free if you meet the requirements. But whether it's traditional Roth or some of these other types of accounts that we're talking about, the main benefit of the tax advantage accounts is you can grow the money inside the account without capital gains tax, without taxes on your dividends, and so on. And over time, that can really save you a ton of money on taxes. So method number 1 is using tax advantaged accounts. So we're going to keep it moving on to method number 2, which is tax loss harvesting. And this is really important if you're investing inside of what's called taxable accounts. So this doesn't apply to retirement accounts like Roth IRAs and things of that nature. But if you're building wealth inside of a taxable investment account, tax loss harvesting is one of the most important things you can do as you go about your investing. And in plain English, if you don't know what tax loss harvesting is, it's really just using losses in your investment portfolio to reduce the amount of money that you're gonna owe on capital gains tax and potentially even your ordinary income. But as a simple example here, let's say that you have $100,000 in gains in your portfolio that you locked in for the year. And you also have the ability to sell off $50,000 worth of investments at a loss. So when we take that $100,000 that we had as a gain and we subtract the $50,000 of losses, we only have a net $50,000, what's called a net capital gain. So in other words, what we did here is instead of having to pay taxes on the full $100,000, we're only having to report a net gain of $50,000. So that $50,000 in gains that we're not reporting can, depending on your tax rate and a number of different things, save you a whole lot of money on taxes. So tax loss harvesting is very important and is something that you need to be able to do if you are managing your own investments. So that's method number 2. Moving on to method number 3, it's owning what's called tax efficient investments. And that's just a fancy way of saying owning investments that have special tax benefits. And there's all sorts that you can look into. We'll talk about some here just briefly, but the main theme to these types of investments is they're considered much more tax friendly compared to other investments, which are less tax friendly. And we'll talk a little bit more about tax-friendly versus non-tax-friendly investments here in just one second. But some examples of tax-efficient investments would be things like index funds. Most passive types of investment funds are considered tax-efficient because, not to get too deep into the weeds, but a lot of these types of investments aren't kicking off what's called capital gains distributions as much compared to like actively managed funds where the fund is doing a lot of trades and generating a lot of capital gains, and those capital gains are basically passed on to you. Index funds, ETFs, those sorts of passive investments are typically considered much more tax efficient compared to the more active types of investments. Municipal bonds, if you don't know what those are basically bonds that in a lot of cases the interest from those types of bonds can be tax-free at the federal level and in some cases also at the state level. So that's a big benefit. Treasury bills. Treasury bills have a lot of tax benefits in the form of state income tax. So in a lot of cases, Treasury bills, the income from those Treasury bills are not going to be taxable to you at your state level. So if you're in a high income tax state like California, for example, that could be something that could be beneficial to consider. So method number 3, very simple, is consider owning more tax efficient investments as a part of your investment strategy. So we're going to keep it moving along here to method number 4, which is asset allocation, or the location that you actually hold your investments inside of. And this is something I see a lot of people not pay enough attention to. And it's something I think you really need to be giving some thought, especially as your net worth grows, especially as your income grows, and as you continue to get closer to your investment goals. So as a rule of thumb, when it comes to, we just talked about a second ago, tax-friendly versus non-tax-friendly investments, as a rule of thumb, you generally want to hold your least tax-friendly investments, for example, like REITs, in the most tax-friendly investment accounts, like the Roth IRA and other types of tax-friendly investment accounts. And on the flip side, you generally want to hold the most tax-friendly investment accounts, like municipal bonds, inside of the least tax-friendly investment accounts, like your taxable accounts, for example. I've seen people make the mistake of getting this backwards. So, for example, let's say that you have a municipal bond fund, and you, as you hopefully know by now, that's a tax-friendly investment because the interest or the income generated from that investment is typically not taxed at the federal level, and in some cases the state level as well. But if you were to hold that investment inside of a tax advantage account, for example, like a traditional IRA, with the traditional IRA, when you withdraw the money, that's when taxes apply. So what you did is you basically removed the tax benefit of the tax-free income from the municipal bond because you held it in the wrong investment account. So that's just one quick example. That's a mistake I've seen people make over time, but you really want to be giving some thought to not just the investments that you own, but also the types of investment accounts that you're holding those investments inside of. Because if you're not strategic about that, you can shoot yourself in the foot when it comes to taxes. And then method number 5 is very simple, is one of the easiest ones on this list, is to simply invest for the long run. So there's 2 types of capital gains tax that you need to be aware of when it comes to investing. We have short-term capital gains and we have long-term capital gains. Long-term capital gains are when you hold on to an investment for over a year and then you sell it. And then short-term capital gains apply whenever you hold to an investment for a year or shorter and then you sell it at a gain. So a capital gain is just a fancy way of saying when you buy an investment and you sell it for more than what you bought it for. So that difference is usually what's considered a capital gain, and that's what taxes can be applied on. Now, why is this important for you to know? Well, typically speaking, long-term capital gains rates, which again apply when you hold on to an investment for over a year and then you sell it, those capital gains rates are usually much lower compared to the short-term capital gains rates. Short-term capital gains are typically taxable to you at your ordinary income tax rate, and depending on your income, that can be upwards of 37% if you're already in that higher tax bracket. Whereas with most people, long-term capital gains rates are anywhere between 15 to 20%. That depends on a number of variables, but to keep this simple, usually the long-term capital gains rates are much lower compared to your short-term capital gains rates. So this doesn't mean you always have to sell investments at a long-term gain. It just means there are some situations where it makes sense to consider holding on to an investment a bit longer to take advantage of the long-term capital gains versus the short-term capital gains. And of course, there's a lot that goes into that, but the main theme here is it pays to be a long-term investor for a number of reasons. And one of those reasons being the fact that the capital gains rates are usually much lower compared to your ordinary income rates. So those are the 5 simplest methods that you can go about using to reduce the amount of money that you're paying in taxes as an investor. And like I mentioned, the more that your income goes up over time, the more that your investments grow over time, the closer you get to your investment goals, the more important this subject becomes, because a lot of people don't realize it. Like inflation, taxes can be kind of like a wealth killer, and they can cause your money to not last as long as you need it to, specifically if you're looking to reach that goal of financial freedom or anything similar to that. So if you're watching this video and you found this helpful, but you still feel like you're not entirely sure of what you're doing when it comes to your investments, or maybe you've been investing for some time now and you just want to make sure that you're on the right track, you want some guidance, you want some clarity, what you can do is in the description to this video and also in the comments, I'm going to leave a link that you can use to schedule a quick free one-on-one consultation with myself. That's an opportunity for us to sit down, help me get to know your situation a little bit better, answer some of the questions you have right now around your investing and finances, and make sure that you are on the right track. So again, the link to schedule that quick free one-on-one consultation is going to be in the description to this video, and I'll also leave it in the comments. But that is the video. That is the 5 simplest ways you can go about saving literally thousands of dollars in taxes as an investor throughout your investing journey. I hope you found this video helpful. If you did, make sure that you give it a like. Leave a comment down below letting me know what part you found the most helpful. And if you're new to the channel and you want to make sure that you're getting more content like this from me, feel free to hit that subscribe button. That way you can get more investing and personal finance content just like this. And again, if you're watching this and you need some help on your investing journey, use that link to schedule a quick free one-on-one consult with myself so we can sit down and have a chat around your situation. But I want to thank you for taking the time to watch this video. Hope you found it helpful, and I'll see you in the next one.